What's up guys, it's Paul here from the 95 Investors Club channel. In this video I'm going to show you how to roll over credit spreads or debit spreads in case they're actually working against you, and do it in such a way that you're either minimizing losses or completely eliminating it. Okay, so I already made a video previously about how to roll over options when you just have a call or a put, for example, but I should have meant to cover spreads as well, but I thought I'd make another video for it so that I can go more into detail, give more examples, cover some basics as well, and then move on from there. Okay, so let me start with put credit spreads. In case you're not familiar with a put credit spread, a put credit spread is when you buy a stock where a lower strike price put of a stock and sell the higher strike price put with the expectation that it stays above the put that you sold. Okay, so let's take an example here. Let's take UWMC, which is United Wholesale Mortgage. I'm clicking on get price, which is the website here. If you haven't heard of it before, it's called optionsprofitcalculator.com. It's a really easy way for you to visualize how different spreads are going to work. You can choose between basics, some spreads, advanced strategies, etc. But getting back to it, so UWMC is currently trading at 918. So let's say a month down the line you expect the stock to actually go up and be above $10. The way you would do that is you would choose the expiration date here, March 19th. You would first buy the 750 put, and then you would sell the $10 put. Okay, now like I mentioned, the put that you sold is what you're expecting the price to stay above by expiration. So in this case, we're expecting it to be about $10, which is why we sold the $10 put. I'm sorry, I chose calls for some reason, but let me re-choose puts. Okay, that makes more sense. So so we sold the $10 put and bought the 750 put, and we're collecting a net credit of $135. Okay, now the way this works is, if once I hit calculate, it'll show you that the break-even price is $865, meaning that if the stock drops from wherever it is currently at 918 down to $865, then you will break even, because you'll need to pay $135 to close the spread. And since you got an initial credit of $135, it basically means that you're breaking even. Okay, so anything below $865 is a loss, with the maximum loss at $750, meaning you would lose $115 at $750 and below. And anything above $10, you get to keep the full initial credit. Okay, so just a quick a basic intro on put credit spreads. So I'm specifically giving you an example of UWMC here, because that's exactly what I rolled over recently. So previously I bought the 750 put and sold the $10 put expiring on Feb 19th. But because UWMC is still dropping and is down to $9, I wanted to give it more time for it to recover. Okay, so I got the same strikes, but I rolled it over to the next month. And the way you would do that is you would go to all options, choose the expiration, which was Feb 19th. I've already done this here, so I'm just demonstrating the process for you guys. I would buy back the $10 put that I previously sold and sell the 750 put that I previously bought to close that spread. Now you would go to March 19th, the next month out. I chose calls previously, so I'm just redoing it to show you on puts. So you would sell the 750 put that you previously bought and buy the $10 put that you previously sold, and it would cost you $109 to do that. But you're doing this simultaneously, meaning you're going to March 19th and now you're buying the 750 put and selling the $10 put again for the same strike price, and instead of having to pay $109 to close it, you're getting a net credit of $26. Okay, so for having done that here, I am essentially holding the new spread here expiring on March 19th, and my overall average credit is $131. And if you look at the spread here, you will see that so the $219 $10 put and $219 750 put was the initial put credit spread that I held. So I closed them here, and I opened the new spread where I bought the March 19th 750 put and sold the March 19th $10 put. Okay, so that's exactly how you roll over put credit spreads, where you're holding the same strike prices, but you're giving it an additional month for the stock to move up about $10, hopefully. Okay, now you can actually keep repeating the process. So let's say UWMC still stays around the $9 range next month. I could repeat the same process for April and potentially collect another $10-15 in credit, and you can literally keep doing it till it goes over 10 and your puts expire worthless and you get to keep the full credit. Okay, so that's the real advantage of rolling over spreads. Okay, I'll give you another example of call debit spreads as an example. So let's start with some basics about a call debit spread, how that works, just as a refresher for you guys. Obviously, you can skip it if you already know what call debit spreads are. So in a call debit spread, you're buying a call of a lower strike price and selling a call at a higher strike price, okay? And your strategy here is you're actually expecting the stock to stay above the call that you sold. So let's say by March 19th, you bought the $29 call and you sold the $30 call. So it would cost you $55, and once I hit calculate here, it'll show you that at 30 and above, your maximum return is $45, which is the value of the spread, which is $100 minus the 55 you put in. So your maximum return is 45. And anything below 29, your calls would expire worthless. So you would lose the $55 that you put in. Okay. Now this currently is pretty safe because Open Door is trading at 35.88. It's these calls are well in the money, so you don't have to worry about it. But let's say they suddenly started dropping and they dropped down to $27, $28 by the first or second week of March. Here's how you would roll that over, okay? So here, as you can see, I'm holding these exact spreads here. I have 20 of them right now, average cost of 25, so I'm actually up 120% on them. So to roll this over, what you would do is you would go to the expiration here, which is March 19th. You would buy back the calls you sold, which is the $30 call, sell the 29 call that you bought, go another month out. Right now, April options are not open yet. They will probably open up in March, but let's just choose May 21st here just as an example. And we would you can sell the same calls or you can even go lower, but in this case, let's just choose the same strike price because based on your analysis, you're expecting it to stay above 30 by May 21st. Okay, so the way you would do this is now you would sell the 30 call again, buy the 29 call, and it's only costing you $5 to roll it over to May 21st, which barely affects your overall cost or overall profit percentage. Okay, so by May 21st, if Open Door recovers and goes back above 30, you'll get to keep $2,000 because for 20 of them, each spread is worth 100 per spread, and if you have 20 like I do, you can walk away with $2,000, and you would only be spending 20 times 5, which is $100 to roll it over to May. Okay. So that's exactly how you roll over put credit spreads and call debit spreads. You're essentially closing the initial spread and opening a new one, but you can do it simultaneously, with the advantage of which is that you're paying a very small amount to roll it over, or you actually get an additional credit like you saw with the UWMC put credit spread. Okay, so same thing, this is exactly how it's going to work even with the call credit spread as well as a put debit spread. You get the point by now, which is why I'm not showing examples, but that's all I wanted to share with you guys here today. If you have any questions or if you have specific spreads that you're holding and you want me to look it over to suggest how I would roll it over, feel free to leave a comment below about that or any other questions you might have. And be sure to subscribe if you haven't already and hit that notification bell, okay? Thanks again for watching, and until next time.